Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if SBUX stock is a buy. SBUX, stock ticker symbol SBUX, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on SBUX. SBUX was founded in 1971 by three friends as a coffee bean store and later sold to Howard Schultz. Schultz converted the retailer into a coffee shop selling espresso-based drinks. The company then rapidly expanded and became a household name. Today the company has over 35,000 stores in 80 countries. Still based in Seattle, the company employs over 400,000 people. Now let's look at the price action. Starting with the 1-year chart, we see that SBUX had a CAGR of about -8%. Zooming out to the 5-year chart, we see that SBUX had a CAGR of 8%. SBUX share price has been a steady climber but has pulled back recently. If we perform a backtest comparison of investing $10,000 in SBUX versus the S&P 500, we find some strong results for SBUX. In that comparison with the S&P 500, $10,000 invested in SBUX would have grown to $19,546 or a 12% CAGR versus $18,848 or an 11% CAGR if invested in the S&P 500. This demonstrates tremendous outperformance for SBUX. However, a SBUX investment would have been more volatile with a 27% standard deviation versus 18% for the S&P 500. SBUX outperformed the S&P 500 in terms of the best year performance, for which SBUX grew 39% versus S&P 500 31%, and worst year performance where SBUX fell only 13% versus the S&P 500 18% fall. In terms of max drawdown, SBUX fell 37%, more than the max drawdown of 24% for the S&P 500. Nevertheless, SBUX did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at SBUX's market share. So we come over here and type in the ticker symbol for SBUX and see that the market share is 4% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that 1 out of every $25 spent for food or beverages goes to SBUX. This is very strong market share. The 5-year market share CAGR for SBUX is 3%. This means that SBUX's market share continues to grow despite its dominant position. If we start in 2019, we see that the market share was 3.5% and 4.2% in 2020. Since then the market share has fallen, with 4.1% in 2021, in 4.2% in 2022, and 4% over the trailing 12 months. Though the market share at SBUX has risen over time, the current trend is downwards and shows no sign of reversal. Let's take a look at the fundamentals. Gross margin is 27%. This is on par with expectations. Revenue has compounded at around 9% over the past 5 years and has reached over $34 billion most recently. Whoa, that is a lot of frappuccinos. Looking at cash flow, we see a 4% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 7% CAGR. As a result, free cash flow has grown at a 3% CAGR. Despite capex increasing as SBUX continues to try to grow their footprint, I think the spend represents a good investment in the company's future. Weighted average shares outstanding have fallen over the last 5 years, going from 1.23 billion shares in 2019 to 1.15 billion shares most recently. SBUX has been buying back shares. This is why so many investors love SBUX. Their commitment to share buybacks is legendary. In fact, almost 2% of shares are bought back and retired every year. Now let's view return on invested capital. Return on invested capital has fallen from 19.5% in 2019 to 15.1% in 2023. This is not good. Starbucks has become less efficient in driving profits from its investments, though this trend bottomed in 2020 and has been improving for a few years now. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 17 days in 2019 to 19 days most recently, Starbucks has gotten a little less efficient over time. Similar to return on invested capital, cash conversion cycle hit its worst value in 2020 and has been improving since. I would not be surprised to see cash conversion cycle continue to fall. Now, let's look at Starbucks' debt. The net debt to EBITDA has increased just slightly over the past 5 years, going from 1.6 in 2019 to 2.1 most recently. No debt is better than some debt, however. Starbucks' debt level is not high at all. Again, 2020 was a bad year for the company where the net debt to EBITDA was also at its worst level at 3.7. Thankfully, this value has fallen since then. Last, let's explore dividends. Current dividend yield is a healthy 2.5% with a dividend payout percentage of 60%. Starbucks is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at an 8.7% dividend per share CAGR over the past 3 years and a 10.4% dividend per share CAGR over the past 5 years. Starbucks' dividend history is clearly healthy, though the dividend growth has slowed over time. The fundamentals of Starbucks are pretty good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Starbucks. It is a restaurant company with a gross margin of 27%. The 5-year revenue per share CAGR is 10% and the 5-year free cash flow per share CAGR is 5%. This is nice. Steady revenue and free cash flow growth coupled with a good gross margin. A return on invested capital of 15% is okay, but it is growing. Next, the cash conversion cycle of 19 days is not bad, but I honestly expected Starbucks to have a negative cash conversion cycle. It seems that their operational leverage is not in inventory control. Concerning debt, a net debt to EBITDA of 2.1 means that it would take Starbucks a little over 2 years of earnings to pay back their debt. So from a fundamental standpoint, Starbucks is pretty solid. Now let's switch our attention over to valuation. Starbucks is slightly overvalued relative to the S&P 500 with a ratio of 1.1. The price to earnings growth, or PEG ratio, is 1.6, indicating that Starbucks is overvalued relative to their projected earnings growth. Starbucks has had steady growth over the past 5 years as noted by its market share expansion. In general, it is difficult to be such a large company and continue to grow because you have already sold to nearly all possible customers. Restaurant stocks are unique in that because food is a recurring expense for all humans, they can not only acquire new customers but sell their recurring customers more at higher prices. Unfortunately, Starbucks does not break out how much of their revenue growth is from recurring customers versus new customers, but I would bet that recurring customers supply the majority of growth. There is really nothing bad to say about Starbucks. 2020 hit the company hard, but Starbucks has rebounded beautifully to improve every major metric. In fact, as China continues to recover, I would expect the fundamentals at Starbucks to improve even further. That is not to say that Starbucks is free from competition. It was recently announced that Luckin Coffee has overthrown Starbucks as the largest coffee chain in China. Clearly, Starbucks needs to continue pushing forward, but I am happy with the pace of progress. The recent share price pullback may even represent a buying opportunity. For me, Starbucks for sure is going on the watch list. Many thanks for watching. What do you think about Starbucks and their expanding market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.